hawkish Fed commentary spooking investors this week, including Chair Powell's comments about a lack of further progress on inflation. It's adding more uncertainty about where the rate cut timeline is going to go from here. Next week, we're going to get first quarter GDP and another key read on inflation in the March PCE report. Joining us now is Krishna Guha, Evercore ISI Vice Chairman. Krishna, welcome. So we started the week a little above 51.50. We're ending it pretty close to 49.50. How much do you trace directly back to Powell's hawkish commentary?
So it's clearly not just the Fed, right? There's anxiety about earnings, particularly around big tech going into next week. There's the unresolved Iran-Israel situation after the first set of tit-for-tat demonstrative attacks, but ones that could yet have escalatory consequences. But there's no doubt in my mind that the shift in the Fed backdrop is a very important part of the reason why markets struggling this week, right? We got a hawkish reset from Powell, not crazy hawkish, a measured hawkish reset. But what came out of that was a much less strong near-term bias to cut rates. And what I think we learned here is that the Fed's base case plan B is July for 2 cuts, but they're hedging. They're also allowing for the possibility that more persistent inflation might mean that rates have to stay on hold past July as well.
So then how much pressure does that put on PCE?
Well, I think we know that the PCE print for March is not going to be good enough, right? We could do the math based on CPI and PPI. And of course, Powell's own discussion this week kind of provided an estimate of where that PCE report was going to land. Nonetheless, I think it makes a difference whether it's sort of a near miss, sort of 0.27, 0.28 type print on core PCE month over month, or a bigger miss in the 0.3s with potentially worse composition, more services categories showing uncomfortable strength. That will set the tone some heading into the following month's data. But at the end of the day, it's going to be the ECI report, that's the wages report for the first quarter, arrives on April 30th. And the April PCE inflation report, and then the May-June reports that come ahead of that July meeting. If they show the pace of month over month inflation increases on that key core PCE measure down around 0.2, we're going to be okay. The Fed can get going in July. If they don't, the Fed can easily get rolled from 3 to 2 to 1, or maybe even no cuts this year.
It's really been the U.S. versus everybody else in terms of the economic picture, with the exception perhaps of Japan. So what is going to matter more when we talk about the global bond complex and even some of the moves we've seen in the FX market and with currencies lately? What's actually going to matter more here? Is it going to be inflation data coming out of the U.S. and GDP data coming out of the U.S., or is it going to be commentary that accompanies the BOJ decision on the other side of the world?
So you're absolutely right that we need to pay attention to all the moving parts here. And it's a complex picture, right? Because, you know, Japan is struggling with currency weakness on the yen-dollar cross, which is driven by what's going on in the U.S. While in Europe, you have the ECB and the Bank of England trying to press ahead with their own rate cut plans based on the fact that their own economies just look very different from the U.S. And I actually think that divergence trade is for real, particularly in the case of the ECB. But at the end of the day, as you guys know full well, it's the U.S., it's the Fed, it's the dollar that sets the tone globally.